Okay, hi there. Welcome to another in our series of videos looking at aspects of economic cycles. In this video, we're going to think about the concept of an economic recovery, one of the key stages of a business or trade cycle. So an economic recovery happens when an economy returns to positive actual growth of real GDP in the aftermath or following a recession. So the economy's reached the trough of the cycle, the low point of GDP, and the national output starts to recover and over time hopefully moves closer to where the previous peak had been before the recession. Now, as the economy recovers, so the amount of spare productive capacity starts to fall. You're moving closer, in a sense, towards your production possibility frontier, and the spare capacity can be measured, for example, by the output gap, a key concept you need to know about, and also by the unemployment rate in the labour market. And eventually, both output and employment recover to where they were before the recession and hopefully continue to grow. Here's a chart showing the index of real GDP for the UK since 2007. And you can see a familiar pattern, the cyclical nature of the economy, the recession in the global financial crisis of 2008, 2009. Then a fairly flat period, and the recovery actually was initially fairly weak. It took actually, if I just put a little dotted line in there we go. Look to see how many years it took, something like 5 years, possibly even longer, for GDP to return to the pre-recession peak. So recovery in the last recession was fairly slow, but then gathered momentum. You wouldn't necessarily call it a boom, but then we had this period from 2013 all the way through to 2019 where the economy was doing reasonably well, output well above what it was beforehand. And then, of course, the pandemic hit. GDP fell by 10% in 2020, but by the summer of 2020, it was down nearly 25% from just a few months earlier. And then a recovery in GDP. So there has been a recovery, and output in the UK is just a little bit above now where it was just before the pandemic. Although had we avoided the pandemic, of course, output would be much, much higher. Converting that level of GDP data into a percentage growth for you for each year, you can see here the figures. And the UK growth is not fast. Our trend, if you like, our long run average growth rate is about 2% a year, sometimes a little higher, for example 2014, sometimes a little lower. And growth, of course, was decelerating as we moved into 2019. Then we took the big hit from the pandemic. A sharp recovery in 2021, 7.5% increase in GDP. But of course, that was only really recovering us back from where we'd been. Growth is likely to slow down in 2022, still 3.9%, higher than in any of the preceding years other than 2021, but more than a halving, essentially a halving of the growth rate forecast in 2022. We'll talk about that in a second. So actual growth, the key thing is that actual growth can vary as it passes through the stage of a cycle. So a recovery doesn't have to be rapid growth. It just has to be a return to positive growth. And a good example of that will be 2010, 2011, 2012, the economy growing each year. Now, so a recovery is the phase of the business cycle that follows a recession, key point. It may take several years for a country's national output to recover to where it was before a recession. And crucially, from an evaluation point of view, there is no single cause of a recovery. Clearly, policy has a role to play, monetary and fiscal policy. We'll talk about that in a second. But so too, what happens in other countries, particularly the interconnected nature of regional and global economic systems. How do you illustrate a recovery using your conventional aggregate demand and supply analysis? I'll use a neoclassical model in this video. So recovery essentially is when you get an increase, there we go, in aggregate demand from AD1 to AD2. That takes the economy to a high level of national output. Could put some upward pressure on prices. Obviously depends on the elasticity of the aggregate supply curve. Oftentimes, though, with a recovery, you get a little multiplier effect. So if investment picks up or if exports pick up, for example, if that's one of the causes of a recovery, that can generate its own multiplier effect. And I do encourage my students to just develop their ADAS diagrams a little bit more, to shift more than one curve to build a slightly more developed analysis. And so that would therefore increase again national output to a higher level. And of course, over time, what you're hoping is that aggregate supply has shifted out as well. So you're hoping that the production possibility frontier will have moved outwards, that the supply side capacity is increased, and that helps to sustain a recovery. So most economic recoveries are initiated by a recovery in demand. Most recoveries are sustained by a shift in aggregate supply, either a long-run shift or, conceivably, an outward shift in short-run supply. You see, for example, it might be the case that your recovery is helped by higher productivity, or it could be assisted by a fall in import prices, or by some deregulation of the economy which stimulates investment. And therefore, if aggregate supply shifts outwards to SRS2, then that allows you to sustain a higher output level, this time Y4, without the inflation. Now, that's quite a complex diagram. It would make a very good jigsaw puzzle, but it does tell a story that recovery is mainly driven by demand, but also assisted or sustained by an increase in supply. And I think that's a really good evaluation point to build into your discussion. So what can bring about recovery? Well, lots of things. There's no single cause. Clearly, policy, macroeconomic policy can be important. So if we think about monetary policy, the central bank of a country might cut their main policy interest rates. Some countries, including Denmark and Sweden and Japan, have gone down to negative interest rates in nominal terms in a bid to stimulate their economies. The UK Central Bank, Bank of England, went down to 0.1% in March of 2020. Central banks also expand the amount of quantitative easing, or QE, by buying bonds off commercial banks and injecting cash into the banking system with the aim of stimulating credit. And crucially, this is a really important point, oftentimes a recovery is helped, given that little assist by a fall or depreciation, fall in the external value of the exchange rate. Some evidence suggests that a 6% fall in an exchange rate for the UK, for example, has a more or less equivalent effect on GDP of about a 1% reduction in interest rates. So please don't forget the exchange rate when you're revising monetary policy. And fiscal policy can have a stimulatory effect, can kickstart a recovery. So Keynesian economists have a strong belief in the power and the efficacy of fiscal policy, particularly if there's a strong fiscal multiplier effect. So direct and indirect tax cuts, higher government spending, some of which is automatic, of course. Please do revise the automatic stabilisers as a concept. Some of it's discretionary, so for example, an increase in public works programmes or higher spending on the NHS in education. Supply side reforms can drive an upturn, particularly if they're effective. So if you liberalise trade or you open up markets, if you provide some tax credits for innovation, for example, oftentimes effective supply side policies can generate new demand. Indeed, there is something called Say's law, isn't there, that says that supply creates its own demand. And there's something in that when you have emergence of new products and innovation within businesses that creates new demand that wasn't there before and can kickstart recovery. And often in a recession, they do say that necessity is the mother of invention. Well, often in a recession, new businesses, new products, new ways of doing things emerge, which can be a catalyst to faster growth. And often, of course, no country is isolated. If a trading partner starts doing better, if their GDP starts to recover, that gives your export businesses more opportunities to sell your goods and services overseas. It could be the case that stock markets and property markets lead an increase in wealth. And overall, what really drives recovery is if the sentiment, the confidence, the animal spirits of businesses, of households turn and start to improve. Because if people have stronger, more confident expectations of the future, they're more likely to spend and invest rather than save. So this slide's quite important. There's never a single cause of recovery. Often it's a mix of external events and policy changes. Of course, recovery doesn't necessarily take you back to where you were before. And here's a really important evaluation point. An economy tends to go through significant change during a recovery. So we're kind of emerging now from the pandemic, and we can look at the numbers, the GDP data, the employment data, etc., and it tells us a little bit about what's going on. But actually, we also know there's some significant changes, people wanting differences in their work-life balance, people wanting to move towards hybrid working. Some industries have grown very, very quickly during the pandemic, others have really struggled. So patterns of jobs will change, industries will grow at different rates, government policy priorities will change as well. Who knows? There could be a change of government. And recovery is never guaranteed. Often recovery can be held back, constrained or hampered by unexpected external events, or as we call them, shocks. So here's our path of GDP again, just to remind you, that's what's been happening in the last few years, these difficult last few years that we've all been struggling through. And the economy has reached a point where it's now above where it was before the pandemic. And we're hoping that recovery will be sustained. But already the forecasts for growth in 2022 are coming down. And there's lots of people writing about this. I just thought I'd pick out 5 threats, barriers to growth in 2022. The first is clearly the cost of living crisis. Inflation is surging, likely to peak somewhere close to 10% this year, averaging close to 7% in 2022. So businesses and households facing that problem, and many businesses held back by labour shortages, particularly of skilled staff. We know, of course, the conflict in Ukraine. Russia's invasion of Ukraine is causing enormous disruption to the world economy, as well as obviously the horrific human cost of the conflict. The pandemic isn't over, so we've had recent lockdowns, of course, in Shanghai and other parts of China, and that's continuing to cause supply chain disruptions for lots of industries, including the motor car sector. Brexit happened essentially 2 years ago, but a lot of export businesses now complaining of the paperwork and the non-tariff barriers holding back their exports and things. And crucially, the central bank, Bank of England, partly because of higher inflation, is now raising interest rates. And although they won't reach very high levels, they could reach maybe 1-2% by the end of 2022. There is so much household and business debt around that even small increases in interest rates could cause a significant debt repayment problem for many people and companies. So recovery in the UK may be held back in 2022. It's likely to be a difficult year for the UK. So there we go. That's my thoughts on economic recoveries. It's a key part of the economic cycle. Hopefully this is useful in terms of capturing the different stages of those cycles and being able to analyse and evaluate them with confidence. Okay, thank you so much. Stay healthy, stay curious, stay happy, and hopefully see you again sometime soon.